Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Tom MacInnis, CEO of Spark Capital Corp and Southern Pacific Resources. Tom is also a board member of Rok Resources, chair of Tennis Alberta, and sits on the advisory committees for the private equity funds managed by Lex Energy Partners. Previously, he was the founder and managing director of investment banking at Tristone Capital, followed by head of energy financial markets and energy investment banking for National Bank of Canada, working on over 1,000 M&A and capital raising transactions, representing over $100 billion in transaction value. Among other things, we sat down and discussed the craft of investment banking, return on capital versus return of capital, and the value of good management. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. All right, well, why don't we start? Tom MacInnis, good morning.
Good morning. Thank you for having me. I'm honored.
I really appreciate your time. Thanks a lot for doing this. For the listener, you are retired now, more or less, but you are still working in your own ventures. I think you are the CEO of, is it Spark Capital Corp?
Yeah, so Spark Capital Corp is my personal corporation, a holdco, if you will, where I invest my capital and try and spend time on things where I invest my capital. And then I'm also CEO of Southern Pacific Resource Corp, which is now a private company, used to be public, that we've recapitalized, which can be for later in the podcast. We can bring that up too.
The best guests are reluctant, just like you. So,
well, I'm more nervous than anything else. And as we were just talking, I tend to forget that some of the things I've seen and some of the things I know are interesting to people. So hopefully I can dig out some of those stories and give you a show.
Again, for the listener, you were an investment banker by trade through your career. How did you get into investment banking? Why energy investment banking?
Yeah, the way I would like to describe it is the reluctant investment banker. I was in investment banking for over 2 decades, but if you rewind the tape, I grew up in Halifax, Nova Scotia, of all places, and I was introduced to energy by given an opportunity to join Pembina Resources, which was a private producer in the mid-90s. And I joined their land group, which helped me learn how to read land maps. And they also had a pipeline division, which was then called Peace Pipeline. And so I learned pipeline nominations and all that kind of stuff, which was just a super introduction to the energy business for me. I went back and did my master's at Western Ontario at the Ivy School of Business, which was life-changing for me in way of thinking and thought process. But Calgary had a draw to me. So getting back to Calgary, I joined ARC Financial, which was then had a merchant banking business. It was just on the cusp of building Rok Resources, which is now obviously a massive business, and also was just on the cusp of raising their private equity funds. And so it was just obviously been wildly successful, but I got introduced to just amazingly intelligent and people started to get a flavor for the business on the financial side of the business and the advisory side of the business. From there, I joined Newcrest Capital for a short stint and met George Gosby, and George and I left Newcrest to start Tristone Capital, which ran for a decade. Post-sale to Macquarie, just after global financial crisis, I joined National Bank Financial to recapitalize their energy franchise, and ultimately led the energy investment banking group, and then ultimately head of financial markets and energy investment banking for National Bank and I was there for over a decade. All of them were great experiences. All of them I'm proud of the history. Loved working with the people at all those places, and all the people I worked with as clients too was awesome. But I got into the business because I'd like to say I was good at it, not because I loved it. I don't begrudge anyone who gets into investment banking and stays there for their entire career and late in their life and knock yourself out. But for me, it was the acquisition of transferable skills. It was the application of what I was good at, spending time with people I like spending time with. And I'd be lying if it wasn't, making money. And so now to apply all those skills and apply capital to do other things has been really rewarding. So, here's my first long answer.
You're pretty young.
I'm 51 now.
And you're retired.
Well, I don't like to say that. But I just I spend my time on things I want to spend time on. And so, and I'm on record a long time ago of saying I didn't want to stay in the business for even as long as I did, but I never found a great stepping off point. And, but there was it got to me later is I wanted to, and I always wanted to push the younger people in the business to come and take my job. And I wanted to push them to there's no ceiling. And when you're ready, I will make room. And ultimately, the guys that are still at National and Arun and Chris, I just couldn't be happier for those guys to push forward because they were amazing when they started. And I'm thrilled that they're taking it on. I have 3 young boys and wife too. And I knew in my career spending as much time as I did in the office and as intense of business as it is, there was a point where I should spend more time being present. And I'm very proud isn't the right word, but I'm pleased with myself that I can see the difference in being present for the last number of years as the kids are still young. And I see the difference of being around, and I notice the difference when I don't answer the phone instantly when it rings, and I'm trying to be present for them and for me at the same time. And then I want to spend time with people who I want to spend time with. And when you're on the receiving end of, I need you phone calls 24/7, for me, that got exhausting. And when the phone rings from Central Canada about the credit book and, the risk associated with such, that got to be a lot too. So I'm just thrilled to have had the opportunity. I will remember lots of details along the way forever. But for me, it was not something I ever intended on spending, over 2 decades doing. And I'm glad that I did. But now I'm hanging out doing different stuff. It's
doing
fun.
Crazy podcasts like this.
And this is new for me, but I have a lot of fun with it. I've been dragged into a few conversations on Twitter, which has been amazingly interesting for me too. But this is next level.
You remember the day you realized you could probably retire?
The day I probably could retire. I think, I don't know who said this, but it's always stuck in my mind. The phrase, you can either make more or want less. And I never wanted to have a heart attack in the office. I don't want to go through life changes at home. I want to make sure I make it. And so the monetary part of it to me is about providing yourself choice and flexibility on how you want to spend your time, not about whether or not I have enough money to buy a helicopter. So for me, don't ask me what that number is. I have no idea. That really was never really the ultimate goal. But at a certain point, and if Rod Graham listens to this podcast, he'll laugh. But Rod's on record as quoting me as saying, if I ever had $1 million, I would disappear. Like, you'd never see me ever again. Of course, that's pre-family and pre-kids and everything. I have a lot of time for people who make whatever money they want to make and then mind their own business. I salute you.
You worked really hard during your career, but when we first talked, you told me the story of seeing Mike Timms. You were excited you got to start in the day. It was 6 a.m. You ran into him and he was already up and about, maybe on his second coffee already. How important do you think people like that have been to the bedrock of Calgary business and the success the city has had?
One of the things that I don't think people appreciate even to today, but fewer people pay attention to it, is there's a lot of bedrock personalities in the city that never get talked about, and don't get fanfare and don't get the pat on the backs or the acknowledgments I'll say I think they should. There are people that and I shouldn't out them. There are people that work hard to get their name out of the paper that have contributed enormous amounts of capital to community of all levels. There's CEOs that still exist that have funded sport infrastructure projects around the city and associated towns that I've never seen an article talking about them. There are people that have subsidized minor hockey in Calgary. And of course, there's going to be people across all sectors, but there's an enormous amount of energy and related energy financiers and builders that have contributed beyond just running their business. And I didn't mean to pick on Mike, but he was on the podcast. It was amazing. He was amazing. I love listening to it. Like I've loved listening to all your podcasts. But here I was as a young banker who, Mike shouldn't even know my name. And I'm walking through Bankers Hall at whatever god awful black time and morning it was, thinking I was there early trying to get ahead and get moving. And here's Mike Timms walking around, like it's middle of the day. And he was very quick to say, hey, listen, like I had said, Mike, you're killing me. Like, I'm trying to get ahead here. And he was very quick to say, listen, you're doing great. This is what I love to do. And that'll always stick with me because he's doing what he wants to do. And I just think that's an ultimate goal for everybody.
Investment banking. Did you view it as a craft? What makes a good investment banker to you?
Boy, that's a good question. Is it a craft? I think it's an art. So it's math. It's a lot of math. You got to understand the math. You got to be able to read the math quickly. But to me, it's what does the math mean? Many of the analysts who I worked with would always get frustrated because they would spend an enormous amount of time building presentations and analysis and whatever. And I would spend nominal time going through it, or flipping pages in a presentation with clients as much as I wanted to, understand the math, but apply the math. So the art of the market, what's the market telling you? What's the market pressure? What's the business pressure? Understanding the people in the business, understanding that the market is living and breathing, but the companies are living and breathing animals. They change over time. They evolve. What's best for the business on day one is not what's best in the business for later. What's in the best interest of the company? What's that feedback? All of that, those information. You need to understand it all in order to give the best advice. And to me, and I still do it, I think the personalities of leadership, of governance, of the evolution of the business from the ground up is what tells the story. And as a banker, if you don't understand that or don't appreciate that, I think you get lost in the math. I understand and appreciate the philosophy of saying there's a market price for everything. So you just put it up for sale and whatever the best price is, that's the best outcome. I understand that philosophy. But I don't subscribe to it. I always wanted to understand the why. I always wanted to push for why now? Why not now? What's going on here really? Whenever someone would tell me a story, say X, whatever, one of my partners would go to a meeting and come back and want to talk it through, I would forever be interrupting and say, well, what did he actually say? What does she mean by that? I'm interrupting constantly because I want to know more. I don't want to know just what the answer was. I want to know why, what was the intonation? What did other people in the room do? I'm forever watching that. And then what do I think? What's the best banker? I don't know the answer to that, but for me, I was watching other great bankers, in my opinion, over time. And I hope that I grabbed a little bit of each that I saw and tried not to repeat some of the things from those that I didn't love. But if there's a core true north for me, it was, this is the facts and this is the truth. Maybe it was some of it was my opinion, but I meant it. So I tried very hard to say whether, XYZ sale process or whatever, if I gave you feedback and said, listen, you're not number one, or, you're a gap away here, I was telling you the truth. And I hope over time I built a reputation for telling the truth. Not to compare and contrast to anything else, but I hope over time people called me looking for an insight, an opinion, an interpretation. They knew if they asked me a question, I would give them an answer. And early in my career, for sure, that got me into trouble. Later in my career, I hope it was just building on a reputation for playing it down the middle of the fairway.
Warren Buffett would say the best investors think like business owners and the best business owners think like investors. Did you view it from that lens, from a banking standpoint, kind of like a business owner mindset? Did you approach it that way?
Probably not until later. I think when you're in the business and trying to, get experience, like once you have experience, experience and expertise begets experience and expertise, right? Once you have it, you build more, and I think you get better perspective. When you're building it, I think you're just in it. You're just in the trenches, and in a market that's so active in the last few decades of so much activity, I think you're just in it. In the bank world, I think I had better opportunity to understand the number of moving pieces and facets that are in the business. And now that I'm not in the middle of the tornado, I for sure have the better opportunity to take a step back and see more logic flow on things like capital allocation that sound simple, but they're not. The ongoing flying debate of return on capital versus return of capital, I think those things are fascinating. I probably spend much more time thinking about and discussing those things now than I did at the time.
The art of the sale. You've seen a lot of deals. In your opinion, why are some management teams able to transact better and not just return capital, but make a return on the capital? What allows them to do that?
I'm a big believer that in general, if you back away even from the details, energy is life. But within energy, cost of capital is life. And in a very capital intensive business, if you start from a place of a poor cost of capital, meaning, for example, a poor multiple relative to your peers, I think it's tough to grow the business. So those that have had great experiences, have a reputation for growth, for adding value, I think, again, it just begets more success. That cost of capital advantage plays itself out over time. On top of that, there are just, this is just not an easy business, never has been, but talent attracts talent. And when you get teams, management teams that have worked together, or just a collection of talent, and sometimes lightning just strikes, but usually lightning doesn't strike a bunch of times in a row. And there's some really good examples of management teams and leaders that have struck gold a bunch of times in a row. I don't believe that's random. And so I think that companies that are cheap and stay cheap, I struggle with them in general. Like there's obviously anomalies. Just because a company's more expensive relatively, I think you have to spend more time and understand why. That cost of capital advantage plays out big time in growth of that business. And I always think about it as a triangle of, the 3 points. You have people, money, and assets. If you have great people and great assets, you'll find money. If you have great people and money, you'll find great assets, right? And all you need is 2 out of the 3. But the hardest one to find would be if I have great assets and money, you can't always find that great team, right? So the value of management, the value of people and the great talent, to me, it's the cornerstone. But for the most part, the best assets end up in the best companies. The best assets and the best companies usually have the best management teams.
There's that intangible management factor that is hard to put a value on. How do you explain that to investors, or how do you put a value on that when you are trying to explain to somebody that this management team or leader seems to just get it, and they know people like working for them, and they just seem to be able to do deals. How do you put a value on that?
I think time puts value on it. So performance ultimately shows up. Private company, sometimes you just don't see it till the end. You don't get to see how the sausage is made. As a public company with quarter results, you get to see it. You get to see what happens along the way. I think that the companies to me that stand out like that are ones that the personality of the CEO matches the personality of the company. The things they do are consistent with that personality. This is something I see on in the energy Twitter world now and I think more people should, is as companies engage with Twitter as an information source and a source of transferring information, I find it fascinating to listen to and watch CEOs that I've known for a long time engage with new shareholders. And sometimes the personality is different than what I think that CEO, who that person is and what the company's all about and what their strategy is all about. I think my point I'm trying to make is the consistency of expertise, experience, knowledge, reputation, what you're great at. If you can make that application of that consistent with what your business is and the assets you are doing and, your game plan and what you're ultimately heading towards, to me, that's the beauty. That's nirvana for me. But someone who's not great at acquisitions, that doesn't have a great track record of buying stuff, buying great assets, developing them and selling them, and you want to run an acquisition strategy, I would look at that and say, what? And what do I know? Here I am on the sidelines watching it. But that's what I'm looking for is consistency.
Some CEOs are just out of my league, but some of the very best ones that seem to be successful are also willing to do things like this podcast, and that there's a alignment, like you say, with how successful they are and how willing they are to just do public things like this. And so, like you're saying, it seems like the top people are just consistent, more or less.
Listen, I don't know.
Like Neil.
Look, Neil's a great example. Brandon is a great example.
I'll just do this podcast.
I love listening to people talk about their craft. Those are great people. I'm not surprised at all they were willing to help. I was a little surprised that you were able to get them to talk about their craft because neither one of them as example, try and be in the newspaper. But I love listening to people talk about their craft. If anybody listens to this podcast and feels the same, then that's a win for me.
Do you remember the best deal you ever saw? It seemed to go from 10 cents to $1, maybe a company, maybe an acquisition.
I try not to, I wouldn't want to single anything out, but the best one I think I've ever seen is still going, which is Spur, which is a private thing. So you can't even see it on a day-to-day basis. But Ian Curry and Clayton Woitas and their team at Spur they've just been ahead of the curve for a while. I've had the pleasure of working on some transaction for them years ago, and that is a class group of people. It's amazing. Spur's an amazing story. But I probably remember more car crashes than I do successes, which is really sad, but very doomy of me, but they stick out in my mind. There was this ongoing thing with a friend of mine who's a securities lawyer, and we remember we call them the top 5 of interesting stories. And sadly, all top 5 are ones that were painful. They're not ones that were big high five moments.
Corporate finance in Calgary is different now than it was maybe in the 80s and 90s. Some people say it's not as vibrant, just the deal making is kind of fallen off with the nature of the industry. But on the other hand, some people think that now is the best time to be a creative deal maker. What's your opinion on that?
Well, let's go back in time first. Let's compare and contrast. Previously, you had a very capital intensive sector, and it's still capital intensive, but the reinvestment of cash flow was multiples of cash flow. So I'll get this directionally right and accuracy wrong, but let's say somewhere between 1.5 and 2 times of every cash flow was being reinvested into the ground. So super capital intensive, which meant that that incremental capital had to be attracted into the space. So you had much more financing activity, let's say 10, 15, 20 years ago than you have today. At the same time, you had a greater number of institutional and sizable shareholders at that time versus today. So you have a reduced number of shareholders, institutional shareholders, less capital flowing into the space. The space needs to rely on itself. That's a big evolution. I think that's a big cornerstone. And on top of it, you've got a market. Now, these things are all related. You've got an investor market that's demanding return of capital, and not this massive reinvestment. And you could connect all those dots however you want, but that's a real dynamic. And so companies are running different today than they ran previously. So so let's park that for a second. I'm a big fan of the logic of the market's always telling you something. It's giving you feedback. It's encouraging you to do something, or it's encouraging you to not do something. There's many years strung together where accretive acquisitions were rewarded. Okay. And we've gone through and hopefully coming out of a phase where we've seen a number of acquisitions that have not been rewarded. The market has been saying, why did you do that? We don't like it. I want you to return the capital to me. I don't want this deal. Why did you do this deal? And that's a very different dynamic that's happened. And so now as you evolve through that whole piece, whether you're talking about asset acquisitions or sales or mergers or big, whatever you want to call it, I think that the sophistication of the logic of why, both on a market messaging and messaging within the business, has become much more sophisticated. So at a different period of time, accretive is good. Let's keep going. You could run a business and say, well, we're going to add this asset and we're going to add that asset and whatever. I think today you're looking at it saying a lot of companies run I'd almost call it a business unit as a company and say, well, now my acquisition needs to be it doesn't just need to compete for capital within my own portfolio, which to me is a big one. But there's got to be a rationale for why we're doing it. You can't just step out and say, well, I'm going to build this thing over there. It's got to be, well, why? I love looking at data. I inhale information constantly. This is my favorite time of year because I get to see year-end information and reserve data and whatever. There'll be lots of people that listen to this that don't spend as much time. There'll be hopefully people that listen to this that spend more time than I. When I look at all that data, it's like, I call it, looking at like the code from the Matrix, right? When I look at it, I see things and it tells me about the company. It tells me about where they are in one year, and it makes me go look at other years, and I see things. I see a need. I see a why. I ask questions like, why, what is going on here? You can see it. If you know what you're looking for, you can see it. And we've seen some recent acquisitions in the last even short amount of time that I think were entirely predictable. What they bought, maybe not as predictable, but the need or the desire to do it, very predictable. What I think is really interesting now is the market going to turn to understanding the need and understanding that it's good. It's good for the business. You can't not reinvest in a capital intensive business. You're not producing widgets and then putting widgets on the shelf and then years later you can go get a widget, right? So in this market that wants return of capital to investors, the buyback versus dividend debate is an amazing one. I get into it constantly for myself. But I think more than anything else, the differentiation between return on capital and return of capital is super important when you're talking about a business. And I am generalizing, but if you're talking a business where your asset is declining by 20 or 25 or 30% per year, you can't not reinvest in that. And I got off topic on your question, which was still a good one. Do I think there's more creativity now? No, I don't think it's more creative now. But I think that the importance of understanding the messaging from the market and the consistency of what you're going to do. with the business and your investor base and where you're going is much more delicate now, and it's much easier to make a mistake. And so I think quality advice, quality partners, quality management, quality investors is more important than ever.
Do you think that presents an opportunity for quality deals and quality investment banks in the corporate finance world, in the sense that if you can do good deals, you'll get rewarded?
I think the separation of, again, like think about a trusted advisor. I think trusted advisors, both on the investment banking space and the legal space, separate themselves in times like this. As an E&P, as an investment bank, as a law firm, there's just three examples: audit firm, whatever. You want to work with the best, but you also want to work with the business that's a partner, right? And so nirvana, I think, is surrounding yourself with partners that are all contributing to success. I think that's magic. Just using somebody and paying fees, I don't know. That's certainly never where I wanted to be. If you go back in time, I should do this someday, but I never wanted to work with somebody once. That always left a bad taste in my mouth. If I never worked with them again, that was never the goal. That was never the goal, and shouldn't be the goal for anybody even starting today.
I've asked a few people this question on the podcast, but criticism of all the deals that went on in the last decade, and it was just paper shuffling. Not much value was actually created. What percentage of the deals, in your opinion, actually created value? Or is it too hard to tell?
It's too hard to tell. For me, the question is, if you think about transactional activity, is I want a company to become something that somebody else wants. So I don't like empire building. And I'm speaking as an investor here, I suppose, but I can't take that away from my own experience.
You're not biased anymore.
Yeah, well, I am because I'm burdened with my own expertise and experience. So I'm burdened by it. And to say that I'm an independent thinker now and I think about it differently, that's not truthful. For sure, my experiences layer onto my investments now. Do I think it's paper shuffling? I don't think you can get away with that anymore. I think you can get saddled with a higher cost of capital, meaning a lower multiple, a worse cost of capital, and it's really tough to get it back. I think it's very easy to lose your cost of capital and tough to earn it. It takes time to earn it, but I think the market today is unrelentingly vicious on judging, sometimes too quickly, what you just did, and especially in the public market, wanting to see the rewards of such. And when you've got leaders in the business that have pulled off counter-cyclical acquisitions that are paying for themselves in a short time frame, you can expose yourself very quickly for not doing good deals. So I think there's for sure examples of time in history where transactions were happening for the sake of transactions, and that even sounds bad, but if you think about in the world of energy trusts, accretive is accretive, and building inventory and, sustainability of dividend. I think it was easier then when you're talking about such massive cost of capital advantages. Today, I don't think it's as easy. And if you look at the number of companies that existed previously, measured in the hundreds, to what the sector has consolidated down to today, it's entirely different. I don't think there's very many places to hide.
Energy is a cyclical business. It's $100 one day and then zero the next. People who've been around in the industry understand that, but yet it seems like people get caught up in when oil's 100. And how long did it take you to kind of realize the nature of the business? And when you look around, are there many people that understand that cyclicality? Is it a rare trait?
I think it doesn't take long to get slapped in the face with the cyclicality of energy. I think the cyclicality of it is changing over time, but I think the important thing has been to understand what the impact is on the business. Like if the business is set up and capitalized to be insulated from volatility, and volatility to me is the more important word, then that's one thing. Transactional activity, if you want to see more transactional activity, you need less volatility. Okay. So you can work within cycles. Cycles impossible to predict. No one's no one should be trying to time the cycle perfectly, but volatility is a deal killer. Just like time's a deal killer, but time's a deal killer because it allows you to have volatility, which can screw things up. But the cyclicality of the business, to me, the real connection there, and something that was eye-opening to me, and I didn't really see it or have to deal with it until I got to National, was the credit. So the credit market has tightened, but to me, the more interesting dynamic is working in an independent dealer and a boutique. Credit was incidental. Like, we didn't offer credit, so we didn't spend any time thinking about credit. I certainly didn't. So we were competing in a totally different world. We were just trying to add value, ideas and execution, research, sales and trading, and relationships and trusted advice. Easy, sort of. The banks, on the other hand, are doing trying to do all of those things and providing credit and providing hedging and providing other stuff. But when the Redwater decision happened, which changed the order of think about the ownership waterfall of, if something goes wrong, who gets paid back first? The Redwater decision meant that the environmental liability, to generalize, the environmental liability went to the front of the line. The banks always thought they were the front of the line, hence the term first lien. Okay, so bank debt is first lien debt. And so when that decision came down, all at this, coupled with the same time of a downturn in energy pricing globally on an accelerated basis, and then a sustained basis, which, if you go back to global financial crisis, only lasted for not even 18 months, right? So by the time people are updating commodity decks to do annual reports and whatever, like, you're almost out the other side of the thing. Not to dismiss the intensity of it, but it didn't last. And ultimately, I don't think a ton of things changed. But this time, some fundamental things have changed. But one of the things that changed is the banks, somewhere between my opinion and what I watched with my own eyes, is I think the banks, the Canadian banks, but I'll say North American bank, maybe global banks, but I don't know. I think they woke up to the risk they were taking with their credit exposure relative to the return they were getting for that credit, and understanding then that they had a mismatch. So for a number of decades, still, the Canadian banks had this big credit business, but I think post Redwater and post a downturn, they, in hindsight, realized they were taking way more risk than they should have been for the return they were getting. And so what's changed now, and I've totally butchered your question, what's changed now is the banks, and I was a part of it, and I agree with it, are saying we want to be a partner in the business. We don't want to just provide credit. So alignment of research, what companies you invest research dollars on, the companies you focus on the sales and trading desk and stay in the flow on the stock, the companies that your investment bankers pay attention to, and same thing with hedging books. They should largely be all the same companies. And I think today, many producers of all shapes and sizes will feel more pressure today than they ever did before, to be a partner with their credit bank. And that's not random. I think that's very different. So if you rewind the tape 10, 15, 20 years ago, you could absolutely, without much fanfare, get credit from Bank A and do other businesses with banks B, C, D, E, and get a little bit of friction over it. But you're really, large syndicates of dealers where you're trying to pay everybody, be friends with everybody, encourage everyone to help. And today you've only got so many fee dollars. In an environment where you have less transactional activity, less fee dollars going around, you've got to make sure that your trusted partners and the partners that are helping you run the business are taken care of. I think it's a very different dynamic. I think it's a very challenging dynamic to to be in a small boutique. I think you've got to outperform in that sense on ideas and execution and be unique. And you've got to be pounding the table on things that others are not providing. I just don't think you can be generic anymore. And I don't blame the banks for saying, listen, we need the hug. We need to hug. We can't just be dating. We need to be hugging. And I get it. But it all dates back to what's changed. And one of the things that changed is credit is different.
Do you worry that from the financial perspective, the business is improving as a whole, but on the other hand, you don't have the old wildcatting days, like the crazy discoveries and the traditional aspect of the business where the massive wealth was found? And
so as a dumb banker, I kind of want to say that's outside my world. But the market's always telling you what it's looking for. And if the market was encouraging you to take that risk and be more volatile as a producer and explorer, I think you'd see it. I think you would see the companies with exploration assets. I think you would see the market encouraging XYZ company to develop said asset, right? But if the equity markets are rewarding return of capital and taking less risk and wanting to see more repeatable plays and less volatility, I think you follow the bouncing ball. But if you go back in time, like, again, this is outside my world, but I don't think you'd have to go very far to find someone to tell you that the basin has been maturing for decades. Is there something left to find? Of course there is. Don't ask me what it is. You do not want me picking dots on a map. That's for sure.
Some people think that that's the point. It's interesting now that the business has been forced into this return of capital, into forcing into a good business. But on the other hand, you don't hear the other side of the story where people are kind of forget about the old Wildcatters and the massive discoveries and all that. And it seems to be part of the business that, isn't focused on as much. But I guess that's just the market is dictating.
I think that's just the evolution. But if you have an appetite for exploration, I think it still exists. It for sure exists on an international scale. It still exists on an offshore scale. So if you have an appetite for exploration, it's there. But at the same time, don't get lost. Like, some of these bigger companies are still exploring. They're just not, the majority of their capital's not big E exploration, right? So to say that, I shouldn't pick on anyone, but to say that the larger companies, aren't taking big shots and making big wells, I don't know. I think there's some big wells being made, and I still think it's there. It's just not as obvious. And again, when you take 300 plus companies and make them into 60 or 50 or 40, you can't see every well anymore.
Yeah. Do you remember peak capital E exploration? When was that?
I don't know about exploration, but if you think about peak sort of transactional activity of mid 2000s, before global financial crisis, of heyday of energy trusts, and of, I don't want to say infinite because that's not fair, but growth of junior companies and encouraged by relatively easier access to capital. That was a very, very busy time. And I certainly wouldn't describe it as easy by any stretch of the imagination. But as oil's moving through 100 to wherever it peaked, 140 plus or minus, that there was a lot of dollars flowing around at the time, for sure. Look, there's tons of examples of things in hindsight that saw a peak. I'm focused on now. I don't think the peak is anywhere on the horizon, but to me now, the bigger question to me is all about capital allocation now. I think that's the most interesting question that people should spend time on.
In terms of your career, opportunity knocks. Do you remember a time in your career when the door seemed to open? You think back on it and things really, the world opening for you?
Yeah, they're like, I think about them as crossroads, and I don't necessarily think them as individual things. I'll say this to kids now, but I do not believe you can go through school and education like I did. Like, you can't do it today like I did it at the time. So I'm not a great student. I never was, but I wrote my GMAT and scored really well. That got me into a great business school. Big crossroads for me. Right. And so these moments, and again, whether it's the individual or not, but being there, I can still remember walking through a empty floor in the Royal Bank building in downtown Calgary with George Gosby, and George had just this vision of what this entire floor was going to be. And I was absolutely saying, what are you talking about? It's just the two of us. Like, we could play tennis in this place. Right. And that's a crossroads. That could have easily not worked. It did. So there's people, but I think if I was to connect it to individual things, there's been people that I've met along the way that I still to this day look and say, you trusted me when you didn't have to, or they might say, you told me the truth when you didn't have to. Those are the things that I relish. And to me, those are the crossroads. So everything in my career was built on, relationships, and then built on experience and expertise. And I have a lot of time for everybody who, does the same. I think it's really cool.
You don't have to work anymore. What motivates you now?
That's a good question. What motivates me now? So I got frustrated a few years ago because I could not find quality information. Read the newspaper, it felt like all opinion to me. Read another, it just felt like somebody blasting me with a view. And so I have this, I wanted just a source of facts. And I still have this view, and I'm not trying to push it on anybody, but if everyone could just be given facts and then provided an opinion from one side or another or a third side, then that would be amazing. And Twitter for me, not to make this a Twitter commercial, but Twitter for me has been an amazing revelation, and I've been using it now for a number of years. And it continues to refine around me, but I find it to be a remarkable source of information that I've never had access to before. And we're talking about a guy who had, like, in whatever levels of whatever banks, I felt like I had access to anything I wanted to. So any question I wanted, I had somebody, whether it's information or an expert in their field, that explained to me an issue. I felt like I had access to it. Today, I feel like I've never been smarter. And so I have a thirst for knowledge. I have a thirst for facts and data, and I just thoroughly am enjoying the world of Twitter, where it can be, if you use it, I'll say use it properly, whatever that means. It is a remarkable source of information that can be audited one way or the other. For sure, it can go off the rails, no question, but it goes off the rails with opinions from both sides. And I have a lot of time for that. And when you think about energy and Canadian energy and public companies on Twitter, I think it's an unrealized resource. And I think it's still in its early days. And there's easy examples of companies of various sizes that have opened themselves up to conversing and exchanging with the Twitterverse, where the resultant difference in their cost of capital is remarkable. And I think it's really cool. And so, sorry, I'm get off topic here. I find that to be a remarkable use of time. Nobody on this podcast cares, but I'm trying to be present on purpose, trying to be present at home, and trying to be involved in what the kids are up to. And I find that really cool. And that, to me, that's my biggest luxury is time. So I'm not trying to change the world in a business sense necessarily. So I'm trying to spend time. So alternative things. I've sat on a number of boards over the last number of years, even though people told me I would hate it. And I think they told me I would hate it because I don't have my hand on the steering wheel. I've loved it. I would do more of it. I look forward to doing more of it. I'm on the advisory committee of the Lex Capital funds based in Regina, working with Dean and Craig, and the rest of the guys have been amazing. So I continue to do that, which has been great. Today I'm on the board of Rok Resources, which is publicly listed. And I've worked with Cam and Bryden and Jared in companies past, working for them as an advisor. And so it's great to be working with those guys again. And their previous companies were private and this one's public. And so again, I'm trying to provide some guidance in whatever fashion I can to add value. And I have tons of time for that. Would I add more boards? Yes. Do I spend tons of time walking around handing out business cards? No. I want to work with people that want to work with me and vice versa. And it works perfectly. And then we talked about it earlier. One of my boards that turned into a bit of a mess, which happens, was super interesting and super taxing mentally. But one of the things in the complexity of it was I spent an enormous amount of time learning about the restructuring business and special loans and blah, blah, blah. But in the world of all that, I have, along with some partners, we've recapitalized this old public company that was in receivership called Southern Pacific. And so we are running Southern Pacific now as a private company, and we're super excited about what that's going to be too. So these little projects come along, and not all of them are in the middle of the fairway. But I think if there's one thing I've realized is, and make it sound bad, but it's not, is I'm trapped by my knowledge and expertise in what I've grown up. Whenever I filter off into different things, I end up getting my head cut off. And for me, I explain it and say, I don't know the people. So I want to invest in people. I want to invest in things I know. I want to work with people I know. I want to work with people that I trust, have had good experience with. And whenever I invest in something that I don't have those things, it inevitably goes wrong. Statistically, it just goes wrong. If there's one consistent in this whole conversation, I hope that's how people look back on, advisors, whether they're investment bankers or lawyers or whatever. Those trusted advisors are critical. Just like investors have their trusted CEOs and CFOs, it all goes around. And if I was that for somebody, then that's amazing. And if there's one thing that I wish I did, is I wish I kept a list of all the people that I work with at all different levels, because people don't stay in investment banking as long as I did normally, or Mike Timms is an even better example. Where those people ended up and what they're doing now and where did they take their transferable skills, to me is the coolest thing. And it's not happen I wish it happened every day, but once in a while I'll get stopped in the street or my phone will ring with somebody who, hey, this is what I'm doing now. And I love it. I love seeing what those guys are doing now. And the fact that somebody would reach out and say, hey, like, to me, what's the best part of investment banking? Now it's getting to see some of the kids that I saw on day one, to see what they're doing today is like jaw dropping in a weird way. It's one of these things where you'd say, I want you to be better than me. So go forth and be better than me, but I am not going to be your obstacle. So take whatever part of me that you thought was good, copy it, use it, and then be better. That's what I want for everybody. And I hope that's what Arun and Chris are doing at National. That's what Tyson Birchel's doing at his firm. And the list goes on and on. I shouldn't pick on them by name, but I watch them do great things and I'm tickled for them.
If you were to give advice to a young entrepreneur, business owner, a person in the energy industry, what would you tell them?
What would I tell them? Let's start with making that banking specific. What would I tell them is hold on as long as you can. It's not fun. In the early stages, you don't have control of your own schedule. That can be emotionally rattling. I can remember family and friends events of all shapes and sizes that I did not go to because I was working on some stupid model that today I can't even remember. I can remember the event I missed. I cannot remember the deal I was working on. So my first piece of advice is hold on as best you can. It's not easy, but the acquisition of transferable skills is incredible and you'll never learn faster anywhere else. That doesn't have to be energy specific, but it's an amazing business for that. And then once you get your feet under you, if you want to take those transferable skills and go somewhere else or do something else or be an entrepreneur, knock yourself out. Go be amazing. That's awesome. But it's a war to get through. So to make it to the end, to make it to a place where you're calling your own shots, being a trusted advisor, it takes time and it takes experience and you have to walk through a lot of trenches to get there. Not everybody does it. In fact, it's very few that end up doing it. Those people in all shapes and sizes, whether you're a research guy or sales and trading or investment banking specific, I don't care what it is. Each one of those people that have become senior in whatever description you want to use, they have walked on glass. Personally and professionally, to get there means nothing. But in the business generally, I would say get out of your office and understand what other people in the business are doing and how it relates to you and how you relate to them. I found that to be really eye-opening in the bank. Easy to say, tough to do, because everyone's busy all day long and they're worried about their thing and how they produce. But to leverage one thing onto another is next level. That really is something else. But the best, and to bring it back to deals, the best deal people they know everybody and they're good judges of people, and they listen to the market and they talk to their shareholders, and they have a good sense, again, for what the market is telling them, and they're listening. No different when you're talking to bankers and you know them enough to know whether or not you're getting 90% of the truth, 47% of the truth. Are they telling you a story? The best of the best know the difference. And the best of the best, when the phone rings, you get answers. Like, I hate voicemail. Can't stand it. I still do, sadly. I still sleep with my phone like 3 inches from my face, because if you call me, I'm answering the phone. I always wanted to answer the phone, because if somebody called me, they call me because they want my opinion, or they want my time, or they want my involvement, and I was be damned if I'm going to miss that call. And the best of the best, they fall in that category of, maybe not everyone's like neurotic like I am with voicemail, but the best of the best, I think, over time, understand the people around their business, where they know what their trusted insight, they know who their trusted advisors are, and they know that when they ask a question, they can trust the opinion. I think that's next level.
That's a great conversation. That's over an hour.
That was funner for me than for you, I'm sure.
I really appreciate your time. I think we can wrap it up there. To remind the listener, you were working on the recap with Southern Pacific. You're on the board of Rok. If you were to leave the listener where to find you, I guess on Twitter.
My phone number has not changed in 30 years, so I am easy to find. I'm on Twitter a lot. I try not to tweet a lot, because now I've found that a bunch of companies that I know me, follow me. So I try not to be confrontational or cause any problems, but I'm easy to find. But I'm intensely introverted, which COVID's been a thing, and not being in downtown every day is a thing. And for anyone who listens to that, I haven't talked to you in a while. Listen, that's me, not you. I'm just trying to mind my own business. I hope you're doing amazing things. And next time I see you, I'll be thrilled to see you.
Thanks a lot.
Thank you. It's amazing.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you like what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.